that just doesn't cut it, right? So I think around the margins you'll see directionally trying to tighten, but it's just not necessarily sufficient to actually make that money worth holding.
What were your reactions when you saw 6.2% inflation?
So kind of that it was like in line with expectations, maybe slightly on the higher end, because my overall window that I was expecting was I wasn't sure if it was going to be higher than the prior number. My only conviction was that it would be around that height, so that it wouldn't really be going down yet. And so there was kind of that big range where nothing would have surprised me. If it was over 6.5%, I probably would have been surprised. It's also partially that you're not just expecting inflation, you're also expecting how they are going to measure inflation, right? So for example, a big component is the housing component. That's what's driving up a lot of the 6.2% figure that we're seeing in the US now. So earlier in the year, when we were getting 4 or 5%, housing was a big drag on that. And even though housing prices had gone up a lot, owner's equivalent rent, which is actually what's in the inflation basket, had not yet come up yet. It was still a very low number. So that was actually pulling the average down. But now we're starting to see that those figures are pushing it up. So rents in the basket are going up, and owner's equivalent rent. Now they're still behind what you'd actually expect if you look at what housing prices did, and if you look at like data aggregators for what rent prices are actually doing. So these are actually still understated. So when you're kind of anticipating inflation print, partially you're trying to figure out what's inflation going to be, and then two, you're saying what is the government's measure of that inflation going to be, that's why I don't try to predict it too specifically. I just know a range that it's going to be in. And so generally we can look at least another quarter or two and say that because of the real estate situation, we're probably going to have sticky high inflation for at least those 2 quarters. And then, as we move forward, we'll get more and more visibility, right? So it's possible that could eventually top out for a period of time and kind of, relax, or something else could happen. We could have another energy crisis. We could have some sort of issue like that gives us another leg higher. But at least with the visibility that we have, while it's hard to say the exact number, it's rather straightforward to say that inflation is likely to be elevated and sticky for at least 2 more quarters.
Do you think we could be going higher than 6.2%?
I do. Yeah, basically, especially if it shows up in the owner's equivalent rent, which is like a third of the basket. As a data point, Invitation Homes is like the largest homeowner in the U.S. It's like a publicly traded business that owns a lot of single family homes, and they raised rents by like 11% year over year on average.
Wow.
And they have this big nationwide complex of homes. And that's not showing up yet in the CPI. The CPI, when they look at rent, they're calling it something like 3 or 4%. They're not calling it 11%. And so that still has, I think, a runway to go. So I wouldn't be surprised to see 7 or 8% official CPI prints. Now, again, I don't have a specific number, because you're trying to estimate the quality with which they're going to measure the number rather than just predicting the number. And so that's hard to say what they're actually going to report that the number is. But based on the next 2 quarters of housing growth, that's certainly possible, unless it's offset by something else. If we have some sort of collapse in auto prices or something like that kind of offsets those housing prices going up, that could maybe keep it in the 5 to 6% range. There's a couple of variables involved and levers to do, but the high conviction thing I would stick to is that housing inflation is going to at least keep it sticky around roughly where it is, or higher, for the next 2 quarters, and then we'll need more visibility and data points to look out the next couple quarters.
What kind of number would shock you?
I mean, no specific no. So I guess the high end right now, so broad money supply growth in the United States is currently 13% year over year, roughly.
Okay.
And so that's you can briefly have price increases go up faster than money supply growth. Not really in a sustained way. As you saw that briefly in the 70s, you didn't really see that in the 40s. So generally 13% is kind of my rough end high estimate. Now it doesn't mean, again, you could touch it for a quarter. It's hard to sustain above that. So generally when you start to get into if you were to breach maybe 10% kind of official reported inflation, I'd find that pretty surprising at the current time. But But overall, I mean, my base case is just sticky and high. So
Yeah.
it's one of those things, and it also a lot of people have hubris in that they try to measure it exactly or say exactly what it's going to be, and of course that's you're combining multiple factors here. So one is you're combining actual things we can measure, like part of why I expected high inflation is because I already saw this big increase in the money supply and was pretty sure that was going to trickle into price increases, was what we're seeing now. So there's that. It's somewhat measurable. But then you also have psychological things, right? So how people's tendencies change, and then you have details like, is the winter going to be cold or warm, because that can affect energy prices, which then can affect everything else. So there's multiple variables that I wouldn't even try to fully guess and be like, okay, it's going to be exactly 8.2%, give or take 0.1. Like that's too specific. But I can look at it and say, okay, here's the money supply growth rate. Here's the historical relationship between money supply growth and price increases. Then we have this big range around the price increases because we actually have to determine how accurately they're going to measure that, which I don't have a super ton of faith in. So yeah, basically, when you start getting to double digits, I'd be surprised. At least in the current environment, if we see an acceleration of money supply growth, then you know that changes that calculus.
So if we were to see, say, plus 10% inflation, I think 10% as a marker would be considered very high. What kind of reaction do you expect to see? Do you think that would force the hand of the Fed? Do you think they would have to change things? Do you think we would see interest rates, raised?
I think you would see more reaction, yes. Now the problem is they can't, in order to give real yields in that environment, you'd have to raise rates to like 11%, and that's not going to happen. So they've been talking about potentially accelerating their taper, right? So currently the Fed's plan is that from now until about mid 2022, they're going to be reducing their rate of asset purchases to eventually maybe get to zero. And then from there, they're talking about...
Do you believe them?
So I do believe that they're going to try that, yes. Now, they left it open because they have a minimum that they're going to buy, but they actually don't have a hard cap. If there's any moment of dysfunction in the treasury market, if there's any sort of illiquidity problems, they can just buy more that week, right? So they're actually not fully committed to that plan. That's kind of that they basically are saying that they're committing to a lower minimum that they're going to buy over the period of time. But I do think that they're going to slow down their rate of asset purchases. There are various signs that basically the banks are already so stuffed full of reserves. It's not doing a ton anyway. And because of certain collateral shortages, there's this demand for T-bills. Again, it actually goes back to the regulation. There's all this regulation that basically forces entities to own T-bills. And so basically, I do think that you're going to see a reduction in asset purchases combined with the fact that the Treasury is going to be probably reducing its average maturity of bonds. So financing more of its debt with shorter duration Treasuries, because that's where the demand is. And so I do think they can do that for quite a while. Now, I think the bigger question is how long can they do that, right? So I have little doubt that they can do it for a period of time. I have doubts that they can sustain that. So I think eventually you would get another kind of slowdown and you'd have another round of QE. And then while this all plays out, I don't think rates are going to get anywhere near being positive real rates, meaning that even if they start to say, okay, this inflation is a problem now, we're getting 8, 9, 10%, or say it's sticky around 6%, they say, you know what, we're going to start raising rates by a quarter, we're going to go up 0.25%, at a time. That just doesn't cut it, right? So I think around the margins, you'll see directionally trying to tighten, but it's just not necessarily sufficient to actually make that money worth